Hey capitalists, we all know that entrepreneurs are value creators. They take financial capital and human capital, add in their secret sauce, then distribute their product or service to the market for a profit. We also know that financiers, those who provide that financial capital to the businesses, do so with the intent of making money, either through selling a portion of their ownership in the business or through an income stream by loaning money to the business. So what if your business desperately needs capital, but banks won't lend to you? And you don't want to dilute yourself or any existing partners any further by selling a portion of your business to another investor. What do? Well, luckily there is still a way for you to raise money. This is Sarah with an H. She's an entrepreneur and she has a good, scalable business model that just needs capital in order to make a wider profit margin. She's gone to the banks, but her revenue isn't quite high enough yet, so they won't lend to her. Eric is an astute investor and he loves her business model and wants to get involved. But Sarah doesn't want to dilute herself or her previous partners who took an early risk on her. Eric needs to be compensated for the risk he's about to take, but they got to figure out a way to do it. So what about a simple loan from Eric with a very high interest rate? When Sarah gets her revenues up, she can use the loan from a bank to repay Eric. But see, Eric can handle the risk, and there are other projects out there that just give him a better IRR than what Sarah could provide. See, Sarah would have to raise her interest rate so high to make it worthwhile for Eric that it would just be a burden to her, especially early on in the project. This would be a caustic deal for them both because the burden of debt would eventually make the project fail. All right, well, what about a lower coupon rate, but add in some equity kickers? See, that's the traditional mezzanine structure, but like we said, Sarah doesn't want to dilute herself or her other partners, so this idea is out. What Sarah and Eric need is a vehicle that is scalable with Sarah's revenues, a note with a comfortable coupon payment, and a revenue share provision. Early on in the project, when Sarah's revenues have not yet grown, she can afford the comfortable coupon payment and the negligible revenue share. But as her revenues grow, so does her payment to Eric. Some considerations. While Eric is an astute investor, he's going to have a very hard time fitting this into a modern portfolio theory framework. Yes, this is a fixed income piece at its core, but the variation in participation income is going to make it very difficult for him to fit this into traditional financial investment analysis. While Sarah and her partners didn't get diluted, they're going to have to live with the fact that they got pushed deeper into the capital stack because Eric got more seniority. Finally, Eric gets no implicit control. Sarah may have to award Eric an advisory board position. Participation notes are becoming very popular in the private markets because they are a great way to raise non-dilutive capital and still give potential upside to investors. They align the interests of both wealth creators and value creators alike. I welcome any comments, questions, or suggestions in the comments below, via phone or by email.